and welcome back to my channel. I am Christy Vann with Fantastic Finances. Today I want to take a little bit of time just to answer a question of should I use velocity banking or just making extra payments? Isn't that going to accomplish the same thing? And the short answer is yes. If you make extra payments, it will end up paying off your loan and it will save you some interest. So with the velocity banking, it does the same thing. So there's a debate on, is it really worth doing the velocity banking rather than just sending in those extra payments? Let's look at it in this way. If you are disciplined and you can take that extra cash flow that you have every month, whether that be $200 or $2,000 a month, and apply it towards, any personal loan, any mortgage, car loan, student loan, whatever you want to pay off. Of course, extra payments will end up paying off the loan as velocity banking. Will it do it in the same amount of time? Possibly, depending on how much of your cash flow that you have and how much you are putting on that loan any given month. Why don't we just send in the extra payments and pay off the loan? That's an excellent question. Why haven't you? It's because it takes discipline, right? It takes discipline to take every last dime that you have brought in and make that extra payment. If extra payments were easy, everybody would be doing them. Everybody would have their loans paid off. We've always known that making extra payments on a loan will eventually pay it off. So why don't we do it? It's the discipline. It's that it takes the discipline of taking a precious $200 or $2,000 that you have saved up in a month and just throwing it out. You are literally throwing it into a loan that you cannot get back. When you make your mortgage payment, if you make an extra $1,000 on that, that is gone. That's not something that you can turn around and use again. With velocity banking, that's what we can do, is we can have access to the cash flow that we have put on our credit card or our line of credit. That's the difference. The difference that in an event of an emergency, you can go use your line of credit again. You have not lost those payments. It is a savings account. It can be used as an emergency fund when you can have access to the cash flow that you have put in to paying off your debt. It is a releasing feeling to know that you don't have to be stuck in a bad place. So for the travelers who travel to go out of states to do their work, as I did with construction, you are in a predicament. You need $1,000 because your car has broken down, or maybe you're just in a place where you need a hotel room that you weren't expecting that you were going to have to stay another night. That is the access that you will have to a line of credit. Whereas if you have made your extra cash flow go into any kind of amortized loan, it is a schedule. Once that money is in that loan, it's gone. And the only way that you can re-access the funds that you have put in to your mortgage or to any loan, once it's paid off, you can refinance your home, you can get the money back out of it in equity maybe, but that's the only way. It's not as simple as just throwing it into a line of credit. The credit sits there and it is available when you need it. That is the only difference. I'm going to show a video that compares if we make that extra cash payment into a loan or if we do velocity banking, the difference in the interest pay, which I have done that in some videos, and it's all telling that there's definitely an interest saving by the way that the velocity banking uses lines of credit to pay off mortgages, car loans, etc. But, putting extra payments on a loan will eventually pay it off as well. So it's in the determination of the person Do you have the discipline to save up your money after you have paid all of your expenses? Do you have the discipline to hold on to that cash and then pay it towards the principal of your loan, never to see it again? Or are you going to need a little bit of help like us all? I had mortgages for years before I ended up paying them off, and that is because I didn't have the discipline to just send my cash flow out the door. Because the fear is, what if I need it? I need to keep emergency funds. I need to keep 3 to 6 months of savings so that I can pay my bills, especially being on the road and traveling with the construction. You definitely want money set aside because things do come up while you're on the road. Snowstorms hit and you need to stay an extra night or two. Life happens, and when we have access to our cash flow through a line of credit, it is so much easier than having to stress out about, where am I going to come up with the money? I need to get a loan from this guy, maybe a coworker or family. We want to stay out of those predicaments. Putting our cash flow in lines of credit gives us access to emergency funds in the event we need them. And it is a game changer when it comes to paying off debt while you have access to your cash flow. Please leave any comments or questions below. I want to hear from you all. What do you think that the best strategy to pay off a debt is? And why do you think that only 1% of Americans statistically ever pay off their mortgage? Is it because that doing the cash payments to the principal amount is really a whole lot harder than, just saying, hey, put your extra cash towards it and you'll pay it off? That is impossible for most Americans, as it proves, or everybody would be doing it. So with velocity banking, it gives you a strategy that you are not only paying off your loans, but you are also having access to funds in the event that you need them.